please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Taking Stock, the show where we take stock of the week gone by and prepare you, of course, what's coming up next week. I'm Surabhi Upadhyay, and with me is Anuj Singhal. Hi, Anuj. I guess been a very, very interesting week for the market, right? When we started off, it was looking like gloom and doom. Then towards the end of the week, we got some, some great bazooka shots, so to speak, which powered the bulls back up. What do you think of it?
Yeah, so you could divide the week in two halves, Surabhi, Monday to Wednesday, and of course Thursday and Friday. Till Wednesday, we continued to make that process of lower low and lower high. I think on Thursday, we firmly broke that. And on Friday as well, though it came off the high point, keep in mind it was weekend as well. A lot of people would have wanted to book some profit. So for me, the big takeaway this week was that Nifty respected its 50-day moving average, is now at 20-day moving average, so could go either way. That's important mark to watch out for. The Moody's move is now priced in, Surabhi. All eyes now on global cues. And I think you will see that from Monday, we'll forget about Moody's move and we'll just focus on crude oil and the Dow and all of that once again would be important point to watch out for. The other thing which happened this week is, though it didn't need reaffirmation, is that the Bank Nifty is firmly the leader of this market. That made a new all-time high. So clearly, I've seen this in the past. When the Bank Nifty is the first to make all-time high, Nifty normally follows suit. So let's see if we have that. For me, I think the key takeaway was that it respected the 50-day moving average. Okay,
absolutely. Well, we will be discussing a lot of those triggers as we go along. Joining us on the show to talk about all of these cues is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, always a pleasure talking to you. Thank you for joining in. So very interesting. The first half of the week gave plenty of ammunition to the bears, and you could start building a case about higher oil prices, rising bond yields, etc. But the second half saw, a bit of the positivity coming back. How do you sum things up and where we stand today?
So clearly, from a flow point of view, Moody's upgrade provides a great opportunity to India. There are many pension funds who don't invest in India because of our lower rating. Now they have opportunity to consider investment in India because of this rating upgrade. Obviously, their flows won't materialize tomorrow itself, but over a period of time, we can see increased participation from pension fund investors who have so far avoided India because of its lower rating. The second thing is participation in the debt market, both offshore as well as local. Again, as the rating upgrade happens, your credit limit on a country as well as its company starts going up. The spread starts reducing. So one side you have the benefit of cost and also the benefit of volume. One could see increased allocation to Indian debt in offshore as well as local market. Local market obviously will subject to the debt limits, but you have SDL limits which is open. Put these two things together, it gives a lot of confidence to investors. And this rating has come to India almost after a gap of 13 years. So clearly very positive from a flow point of view to the equity as well as to the debt market.
Okay, Nilesh, always good talking to you. So, this is a question that I've asked a lot of people today. If global picture also stabilizes a bit, do you see a bit of a melt up for our market over the next couple of months or next 3 months if everything falls in place?
Anuj, we have started hearing this term melt up suddenly. And all the ingredients which are necessary for melt up are definitely present in market. There is liquidity chasing stock. There is expectation of enhanced flows from the foreigners. People are also not seeing commensurate return in alternative asset classes like fixed income and gold. But my hope will be that this opportunity be encashed by government for divestment and creating supply. This is the best time to provide supply to the market so we don't end up into a melt up kind of situation, because whenever we go into that kind of situation, it will attract hot money, it will attract uninformed investors, it will attract dumb money, and later on they'll have to pay the price. It's far better for investor confidence that we gradually go up rather than melt up.
Fair enough. But what about the concerns, Nilesh? The price of oil, which continues to be in that range of 62, 64, and the fact that the bond markets are sort of giving us a nervous sign with yields continuing to be fairly high at 7%. Is that a concern for equity investors?
So undoubtedly on oil prices, we don't have much control. However, broadly the consensus is that this jump in oil is attributable more to the geopolitical events, especially what's happening in Saudi Arabia. It is less reflection of demand-supply mismatch. So we have to hope and pray that oil prices will remain between $40 to $60 and they wouldn't remain elevated for a long period of time. A spike of a month or two due to geopolitical event can be absorbed by the market, but if expectation remains of an elevated oil prices, then to that extent we have to make correction in our fiscal stance as well as in our current account deficit. Clearly Moody's have not bothered about what's happening to oil prices and what stress it can cause to India's fiscal deficit in reaffirming this rating upgrade. The second thing is on interest rate side. Now clearly there is a transition where RBI earlier used to manage growth, inflation, money supply, banking system stability, currency and government's borrowing program. Today they are mandated to manage inflation around 4% plus or minus 2% level. Now if RBI manages inflation at 4% level over a period of time, that will definitely reduce inflationary expectation. And then if we see the real interest rate which is available on a 10-year government securities which is running at about 7%, clearly 3% is too high a real interest rate. I was this week in Thailand marketing our equity fund over there, and I saw bank fixed deposits being offered at 2% interest rates. Thai deposits are lower than 10-year US Treasury. So clearly, if an emerging economy like Thailand could have a lower cost of capital, lower deposits, lower real rate of return, there's no reason to believe that over a period of time, not necessarily tomorrow or day after tomorrow, but over a period of time as RBI anchors inflationary expectation around 4% mandated level, the real interest rates has to come down, the nominal interest rate has to come down. So on interest rate market will take comfort that interest rates eventually will come down. However, market, as Anuj mentioned, will have to start looking at oil prices far more carefully if they remain elevated.
Nilesh, what about politics? Your home state goes to election and will have, of course, outcome in a month. There's been some murmur of whether, if the ruling party does not win with, same majority like they did or like they have been doing for last 3 terms, in that case, there could be some nerves for the market. Do you agree with that view?
Undoubtedly, today market has priced in continuity of economic policy and more importantly with a rating upgrade, a kind of second generation reforms to be unleashed. It's not that we have reached Paneka of credit rating. It's not that we have reached, peak of economic growth cycle. We have to unleash second generation reforms in labor, in ease of doing business, in faster and speedier infrastructure development. So clearly market is pricing in continuity of economic policies and extended economic reforms. Now if an election result kind of gives an outcome which is different or contrary to this expectation, then certainly market will have to make an adjustment. So people will be watching Gujarat and Himachal Pradesh election results. Himachal outcome will have limited impact on market, but Gujarat outcome, being home state of Prime Minister, will definitely have material impact on market.
Finally, Nilesh, in some ways, I think the sector of the week was real estate because of the news that we got on Thursday with the scope of this subsidy on affordable housing being extended. Do you like real estate plays that are available right now? If not real estate, then housing finance companies at current prices and valuations, are they still a buy for you?
So It's a very, very interesting question. We do like real estate as a sector, especially with government unleashing reforms in that sector from demand as well as supply side. On demand side, they are extending interest rate subvention schemes. They are allowing EPF for premature withdrawal for buying of a house. So this is creating robust demand. On supply side, they have enhanced affordable housing limits. They are giving speedier approvals in certain parts of India. The problem for us is to find out right vehicle. In real estate, some vehicles are over leveraged. Some companies are having questionable governance track record. So in the listed real estate space, there are very limited opportunities. We think it is far better to play this coming real estate boom via ancillary sectors rather than pure real estate sector. And as you mentioned, housing finance company, apart from that you have cement, building materials, cables, wires, paints, all those kind of ancillary sectors where we believe growth could be higher than what is expected by the market, and hence it might be equally rewarding like a real estate company.
Okay, Nilesh, always good talking to you. Have a good weekend, and of course, we'll touch base with you next week. Well, it's been an interesting week that we are taking stock of. For the week, the Nifty was still down about 0.37%, though of course the Bank Nifty made a new all-time high, and the mid-cap index ended in the green. Didn't look like that till Wednesday, but then of course on Thursday and Friday, we had big rally. Joining us now is Ashwini Gujral with his view on the technicals for the market. Ashwini, so where does this week leave the market? Still buy on dips, the larger trend?
Well, very, very small correction, 1.5 week worth of correction, 8 down days. So still an uptrend. I think possibly maybe tomorrow itself we could cross today's high and start moving on, and that would give fresh buyers an opportunity to participate in the momentum. So I don't think I would take the last hour sell-off very seriously. I think the correction is truly done and over, and once the US markets and global markets give follow through on the upside, I think we should also move higher.
Ashwini, the one stock that I had in mind was Reliance this week, because it's undone a lot of the damage that we were looking at last week. It fell about 6.5%. This week it's risen about 3.5%. So could Reliance be a key pillar that takes this march forward?
See, that seems likely. Not only that, since rupee has fallen back towards 65, I think IT will also come back, and this entire rally was led by Reliance, banks and IT. I think next week onwards, IT will also show better participation on the upside. So Reliance is still a fairly decent buy here.
Okay, what about the Bank Nifty, Ashwini? That clearly remains the leader of this market. Thoughts here on what would be the next levels to watch?
See, Bank Nifty clearly did not correct and move sideways. Now that was a very strong signal that it's likely to see greater upside. So immediately 26,200 could be a target on the Bank Nifty.
Okay. Let's discuss your stock ideas then, Ashwini. We've discussed Reliance. That's also on your list, by the way. But other stocks?
See, housing finance seems to have bottomed out. So Canfin Home is a buy with a stop of 470, target of 495. Pidilite is a buy with a stop of 825, target of 860. And RIL is a buy with a stop of 895, target of 940.
Okay, so those are a couple of the ideas that Ashwini is going with. We also have some queries on Twitter that are coming in. So let's see if we can get some of those questions answered as well. Twitter user VSN Kumar has 600 shares of JK Tyres. He bought them at a price of 167 rupees. He wants to know the outlook on the stock and whether he should hold on or whether he should exit out. Tire stocks, Ashwini, gotten into a bit of a volatile ride of late. JK Tyre in specific, any views there?
See, the best of the tire rally seems to be behind. Now these guys are not participating as much on rubber prices falling, etc. And JK Tires is in fact fallen below 200-day moving average. So I think maybe he needs to move on to an MRI for a CAT, or better still, out of the tire space, because it is not participating in market rallies a whole lot these days.
Okay, we have a Twitter user Sarda with 288 shares of Lupin, and guess what? The buy price, 13.23 per share. She wants to know if she can hold it for a long time. I'm guessing now it's the view turns long term, Ashwini, because it's fallen so much in a bear market. What next here?
Well, like small caps become blue chips. Sometimes blue chips can become small cap, and you should not try to find out if they can become. What do you say to this sort of a price? It's been in a continuous bear market. You need to have stops in stocks. But Lupin, it'll take a while. Even the management says don't expect too much this year. So if I were her, I would not add on. Keep it. Maybe the worst is priced in. If you are lucky, maybe long term you get something out of it. But if I were you, I would at least now not let it fall another 100 points. So let that be your stop loss. If it gets taken out, then you are out of Lupin.
Okay, you need to take the pain and move on if it falls another $100. Twitter user Prasanna holds 40 shares of Bombay Burma Trading Company. Buy price was 1300 thereabouts, 1303. He wants to know both the long-term and the short-term view on the stock. So, made good money on BBTC. I guess those who got in at the right time, they have made a lot of money on the stock, Ashwini. What's your advice now, looking at the buy price?
See, Lupin is a perceived blue chip. It keeps moving lower. Bombay Burma, people are not so sure it's a holding company, trading company, etc. That keeps moving up. So I would think this is still a pretty good stock. Probably keep a stop, say closer to 1350 thereabouts. And once the rally restarts, we should get back towards 1700, 1750.
Okay, Ashwini, thanks a lot for your time today. Have a good weekend, and of course, we'll talk to you Monday morning. Well, that's all the time that we have on Taking Stock, but we leave you with some of the biggest voices that we've got all through this week.
The bull market, which I anticipate the long, biggest bull market in India, I think has just started. It will make cost of fund lower for India as a country, and it will allow a lot of foreign capital to come into this country.
No,
which is good.
Very important point,
right.
Because that was the thing missing.
So that will help revive that will also help revive the investment cycle.
As long as inflation remains relatively moderate, I think that the financialization of assets is a theme that is here to stay on a structural basis. And I think that, India has got such a large pool of savings that at the end of the day, the FIs should not be the tail that's wagging the dog. We're at Nifty's at 10,300 right now, approximately. I think that, if you're talking now 15, 16, 17 months, right, for the election, if we're assuming May of, then it's more like 18 months till May of 19. I mean, I think, 10 to 15% move is very reasonable. It's certainly a pleasant surprise. I don't think anybody was expecting it at this time, especially given that, there were some nascent signs of inflation. But I think Moody is making a long-term call, and I think, therefore, kudos to them and kudos to the government for getting the recognition for the long-term benefits of some of the moves like GST.
The Indian macro is on a very solid footing. I think growth is turning around in India. The one-time effects caused by demonetization and then the implementation of GST, I think, are largely behind us. I think that growth will likely surprise on the upside over the next 12 months. The point you make on oil is certainly a risk, and I keep a keen eye on that. I don't think that episode in the Middle East is over, so it still presents a risk. I think the recap is obviously a very big inflection point, and nobody should underestimate the power of this recap. It's a very appropriate amount. It's not half-hearted. I think the government has gone the whole way and has decided to fix the capital situation with the SOE banks. And therefore, this does help all the corporate banks, even the private sector corporate banks, to fix the NPL problems that have been hurting them for the past few years. So I think that we could be entering into a period where corporate banks outperform the traditional favorite space for investors, which is retail banks.